A very good morning to all of you students. Today we will continue on the topic of options from the topic of derivatives that we were studying. So students, in our previous class, we have discussed about the basics of options, specifically on the call option and put option. We understood how these instruments, the terms and conditions are defined and what are the implications from the holder and writer perspective. We also did two examples on the call option and put option payoffs when it comes to the gross settlement as well as the net settlement. So let's start from the today's point of view. So students, first of all, we will cover some of the payoffs related diagrams so as to help us understand better that how the pricing of options moves. Good morning, Shruti, Shailesh, good morning. So let's start with the first payoff, in which we are taking an example of a option which has a strike price at the rate 140, strike price only at the rate 40, and premium of 5. And this we are talking about call option. Okay, so the first part we are talking about a call option, and this is from the perspective of the buyer or holder. And today we are introducing a new term to it. Can we say that who's the buyer or holder of the call option? He's taking a long position in call, or I can say long call, correct? Long call means this person has purchased the call option. So if with this you assume here, this is the price of share, okay? And this is the payoffs. Let's say it is 0, 5, 10, 15, 20, 25, 10, 20, 30, 40, 50, 60, like that. Okay. So on the y-axis, we have plotted the payoffs. On the x-axis, we have plotted the price of shares. So till the time the price of share is below 40, the person who is holding that call option will suffer a loss equal to the premium. Premium is how much? 5 rupees, right? So that person will be suffering the loss till 40, right? Then once the price is actually going higher, the payoffs will also become higher. And here it will touch at 45. Why? Because 40 was the strike price. So if the spot price goes to 45, then net 5 rupees gain will come to the call buyer. However, 5 rupees premium is already paid, so 0. So that means at 45, the payout will be 0. Okay. So the payoff will be 0 at 45, hence what we have denoted here. So here we can say that benefit to call buyer if the price at expiration crosses beyond 45. If price crosses beyond 45. Okay, students. In this case, loss is limited. However, gain is unlimited. This is what is visible, right? So the gain is unlimited to the call buyer. However, the loss is limited. Okay, students. I hope this is clear till now. Then let us move to the second type. Second type of payoff, let us study it from the point of view of call seller. Or we can say the person who is doing a short call. Further, we can say that he is the writer of call option. I hope all the terminologies are clear. Here also the strike price is 40 and premium is 5. Hi Namrata, good morning. So correct, these are the prices 5, 10, 15, 20, -5, -10, -15. Now, students, if you see, we are talking about the point, we are talking from the point of view of call seller, who is the writer of the call option. So, till the time price is up to 45, there will be a gain to the writer because there is no effectively higher payout than the premium that he or she has received, correct? So, okay. So the loss will be unlimited. However, the gain is limited. This is from the point of view of writer of the call option that we have discussed yesterday, right? Gain is limited, loss is unlimited. Further, it will dissect this at 45, correct? Reason being at 45, the payoff will be 0. So again, this is the price and this is the payoffs. Okay. So can we say that loss to call seller in case the price goes beyond and above the strike price. Correct? Strike price plus premium or strike price, whenever it will go beyond strike price, the loss will start coming into the call seller. Clear, students, till now? Okay, now the third case. Let's talk about the put option right to sell. Correct, students? This is a put option right to sell. Here, the strike price again we are assuming as 40. Premium we are saying it as 5. Okay. And we are talking about the party side as holder, or we can say the person who has done the long put, or we can say who is the put buyer. Okay, by whatever name we want to call it, we can call it. Okay, Okay, so these are the prices again. These are the payoffs. The students, what happens in case of a put option? The buyer of the put option will have a benefit when the price, the share price actually moves down the strike price. Okay. Because if the pricing is lesser than the share price, then only the benefit will happen. So we can say, okay, again it will meet at 35, correct? Because at 35, the payoff will be zero. The net gain or loss, I mean, will be zero, right? So here also the loss is limited. However, gain is unlimited. Okay. So here what we say, benefit to the put buyer in case the price goes down below 35. Okay. If it is going down below 35, then only the benefit will accrue to the buyer. Dear students, will we move ahead? I think the last case, which is put option, seller who has done the short put, correct? Or we can say the writer of put option. From this party's point of view, what will be the payoffs chart if we make strike price 40, premium 5? Net payoffs, price. Good morning, Viraj. Okay, so this is this is how the price and the net payoffs again the chart I've plotted. Now in this case, since this is from the point of view of put option writer, the gain will be till the time the prices are above 35. The moment prices goes below 35, there will be a loss. Here, gain is limited and loss is unlimited, students. And the loss will be higher in case the price goes down and below 35. Correct? I hope this is clear, students. So put option seller will have a loss in case the prices of the shares goes down. Okay, everyone. I hope this is clear. All these four charts are clear. So the payoff for call option buyer will look like this, where it will increase the moment share prices also increases, and it will increase to infinity. The call writers will look like this, where the loss will increase the moment share prices start increasing. The put option buyers also, the gain will increase if the price comes down. And for the put option writer, the loss will increase if the price comes down. Okay, students? Yeah. So let's talk about, even one of the query was there from yesterday, right? Where it was being asked that in this case of options, the prices are not variable, the prices are fixed. I told you that I will discuss that today. So let's discuss it now. So students, if we talk about first of all an equity market, okay. So in equity market, this is, let's say, a stock exchange, and here the prices are being quoted, right? The spot prices are being quoted. Now there is a buyer to it and there is a seller to it. Correct? That's how it happens. So this price is depending on the market forces. Similarly, in case of a futures market, okay, again, let's say this is a stock exchange, and here the futures prices will be moving up and down. The buyer will be there for future and the seller will be there for these futures. Okay, this is clear and easy. Equity and futures market is clear. Now let's talk about the options market. Options market, still there is a stock exchange. There is a buyer. There is a seller. Seller we call it as writer. Buyer we call it as holder. Correct? That's how we call. However, the prices that are quoted on the stock exchange, can anyone guess what will it be? Students, can anyone guess what is the price of an option? What is the price of an option? Okay, students, can we have some thoughts on what do we mean by the price of the options, or what will really come over here? Yes, very nice. Pradeep, Namrata, very good. Okay. So this is premium. So the price of the option that will be visible on the options stock exchange will be the premium, students. So that essentially means that the buyer or the holder and the seller or writer from this end will deal on the premium. Yes, Namrata. So there was one question yesterday, right? that the price of derivative here also I'm not saying it is fixed. See, only the strike price is fixed. Okay, but the premium, which depends actually on two factors. One is the strike price, and second one is the spot price. If the spot price is higher than the strike price, premium will also be higher. If the spot price is less, in case of a call option, if the spot price is higher than the strike price, the premium will also become higher. If the if the spot price is lesser than the strike price, in case of a call option, the premium will become zero. You're getting my point, students? Okay. So the prices are also very much floating. It's not that the prices are fixed, only the price of the underlying in the contract is fixed. Good morning, Tanisha. Okay. I hope this is clear. So let's say today I purchase a call option at the rate of 5 rupees premium. Now tomorrow that premium can increase to rupees 10 also. And if I want to sell it, I will sell it. Okay. On the stock exchange. So that's how the premium is playing an important role in the options trading. And hence I told that this price, which is not fixed, which is variable, is for the premium, because the premium is this price for the option. Okay, I think that question was from Shruti yesterday, if I'm not able to recollect. Shruti or yeah. No, Mansha, strike price does not include premium. That's not the case. Strike price never includes premium. Premium is an outcome of strike price and spot price. That we will study through different questions today, students. Okay, let's come to question number 1. Okay, question number 1 says that equity shares of PQR Limited is presently quoted as 320. The market price of the shares after 6 months has the following probability distribution. So they have given us the they have given us the market price and probability. The put option. Now, students, please see there is a put option. Whenever there is a term called put option, all of you should think that the question is talking about a right to sell. Okay, we have to be clear in our mind that the question is talking about the right to sell. And the strike price of 300 can be written. You are required to find out the expected value of option at maturity, that is at 6 months. So students, wherever the probability is used and wherever they say the expected value, the operations are simple, right? First, we have to calculate the individual values, multiply it with their probabilities, arrive at the overall amount. Now, the strike price of this put option is 300, right? If you see, students, at 300, if the price becomes at 300, this will be at the money, correct? And if comes out to be lesser, if it comes out to be lesser, then it is in the money. If it is higher, it becomes out of the money. Okay, students, this is clear. So, in a way, we will have to calculate the we have to calculate the difference of strike price and the spot price at each probabilities, multiply it with the probability to arrive at the expected value of the option. Yes, Namrata, holder can play on premium. Even seller can also play on premium. Okay, anyone can play on premium. Expected value of put. So the probability, let's first put down 10, 20, 50, 10, and 10. Then the market price students was how much? 180, 260, 280, 320, and 400 students. Now the put option uh, value will be how much, students? Put option value will be how much? Tell me. The strike price is 300. The market price has gone down to 180. So would there be a gain? Would there be a gain on account of this? Tell me, students, come on. So if this market price has gone down to the strike price, would there be a gain in case of a put option? So, no, Tanisha, there will be a 120 rupees benefit, right? There will be a 120 rupees benefit because the strike price, the market price has gone down below strike price. The moment it happens, there is a gain. We have seen in the payoffs yesterday, right? Because the person who is holding this instrument will have a gain. And this instrument itself will be in the money, right? My question was whether this instrument will be in the money or out of the money. This instrument will be in the money at 120 rupees. Similarly, here at 40, here it will be 300 minus 280, which is 20. Here it will be nil. Okay. So the probability multiplied by the option value will become how much? Will become 120 into 10%, which is 12 rupees. 40 into 20%, which is 8 rupees. 20 into 50%, which is 10 rupees. Then nil nil for these. So 12, 8, 20, and 10, 30. So the expected value of put on expiry will be rupees 30. Okay, students? Yes, Namrata, very nice. I was about to tell you, all of you, is that if there is a forward contract in this case rather than an option, or if there was a future, then there would have been losses here and there would have been negative values, which would have reduced your overall expected value. Okay. But since this is an option, so the person will not exercise if it is lesser, and hence there will not be any loss altogether. There will always be a gain, students. Okay. If the market price is same, then in that case it is at the money. If it is at the money, the put option value will be nil. Okay. So can we say now this question is over, right? I'm just putting one discussion point. Long call means purchasing right to buy. Okay. Long call means purchasing right to buy. Put writer means quickly selling the right to sell. This is purchasing right to buy and this is selling right to sell. Okay. Now purchasing right to buy means the person will, if exercise, the person will purchase the underlying. And similarly, in case of put writer, the person who is selling the right to sell will also purchase the underlying. In case the option is in the money, then this person has to purchase the underlying. Correct? Clear, students? Then I hope till now we are clear. So if I ask you that logically, what is the value of option? Logically, if I ask you what is the value of an option, can we say for value of call option, expected price minus strike price? Let's say expected price is 120, strike price is 110. Maximum a person will give 10 rupees as premium. Correct? Think through. Think through whatever come and go. A person will not pay a premium higher than what he expects to earn from that option. Correct? And similarly, the person who is selling this option will bare minimum expect 10 rupees because that seller of the option thinks that on expiry 10 rupees needs to be paid. Okay, students? So the expected price, howsoever, will not be higher than 10 rupees. No, Tanisha, it does not mean that. What I'm saying is, in this case, the person who has done the long call, that means the person has purchased the right to buy. Here, the put writer has sold the right to sell. So both of them have to purchase the underlying. Ultimately, if the option becomes exercisable, both of them have to purchase the underlying. Okay. So what I was trying to say is that don't Don't basically make it as a thumb rule that whosoever is purchasing the call will purchase the share, or whosoever is purchasing the put will also purchase the share. It's not like that. Okay, I am telling you that you think always from the contract which is given to you. Okay. Similarly, the value of put option will be strike price minus expected price, which is, let's say, 110 minus 90. Okay. So this will be the value of the put. I'm just taking an example here, okay, which is 20 rupees, students. So the strike price would be higher, and if the expected price goes below strike price, then only the value of put will come into play. Okay, students. Question number 16. Sorry. So question number two, not 16. Question number two, you, because it's from the second assignment, student, that has been uploaded. Okay. The question number one we have done from the second assignment, then another question number two from the second assignment. You as an investor had purchased a 4-month call option on the equity shares of X Limited of rupees 10. Okay. So there is a 4 months call option that has been purchased, of which the current market price is 132 and the exercise price is 150. Okay, the current market price is 132 and exercise price is 150. You expect the price range to be between 120 to 190. The expected share price of X Limited and the related probability is given as below: 120, 140, 160, 180, and 190. Okay, students. So from 120 to 190, the range is also given, the probability is also given, and they've given the exercise price as well. Compute the expected share price at the end of the 4 months. So first of all, they're asking us to calculate the expected share price. So expected share price will be just nothing but just probability multiplied by the expected price. Calculation of expected share price. Okay. Price 120, 140, 160, 180, and 190. Okay, so the probability is 0.05, 0.20, 0.50, 0.10, and 0.15. Price into probability will be 6, 28, 80, 18, 28.5, 160.50, students. Okay. This is the expected price, expected share price. Simple. This has nothing to do any other concept, just probability multiplied by the price. Second part, value of call option at the end of 4 months if the exercise price prevails. So the value of call option at the end of 4 months if the exercise price prevails. So let's come to the second part. Value of call option if exercise price prevails. What will be that value of call option? I just presented in terms of the logical manner. How does it looks like? Strike price minus the spot price. Okay. Minus spot price. And the question says that the strike price itself prevails. So whatever is the strike price, the spot price also becomes equal to that. So 150 minus 150, which is equal to 0. So the moment strike price becomes equal to the spot price, or we can say that the spot price becomes equal to the strike price, the value of call option will become 0. Reason being, now no one will pay for this call option because ultimately the value derived from this is 0. It has become at the money, correct? I hope students this is clear. Now let's come to the third part. In case the option is held to its maturity, what will be the expected value of the option? Now they are saying what will be the expected value of the option if the option is held to maturity. Again, now we have different probabilities. For those different probabilities, can we calculate the different value of options and then arrive at the expected value of the option at the end of the 4 months? Expected value of call option on maturity. We will put price, value of call option, probability, and probability multiplied by the value of call option. Okay. So the price was 120. Let me first put down all the prices: 140, 160, 180, and 190. So students, what is the strike price? Strike price was 150. So if the spot price moves to 120, whether call option will be in the money, at the money, or out of the money? It will be out of the money because the spot price has gone below the strike price. Similarly, if it is 140 also, then it is out of the money. Now 160 is the spot price. So 160 spot price minus 160 as the spot price minus the strike price of 150, that will become 10 rupees. Similarly here 180 minus 150, which is 30, then 40. Sorry. Student, there is one correction actually here. I should put vice versa. I should put here spot price first minus strike price. Correct? So yes. So 190 minus 150 will give us the value of call as 40 rupees. So the probability will be, which is given in the question, 5%, 20%, 50%, 10%, 15%. 5, 20, 20, 40, 10, 50, 1. So this is all 1. Okay. Now this probability multiplied by value of call will be 0, 0, 0.5 into 10, 0, 0.0, 0.5 into 10 will become 5, 30 into 0.10 will become 3, 40 into 0.15 will become 6. So this in totality becomes 5, 3, 8, and 6, 14. Perfect, Tanisha. Yes. 14. Okay, students. Students, there is one more option to solve this. Has that come to anyone's mind? See, we have calculated the expected share price here. Okay. And for the purposes of third, can we not use that? Can we not say that the value of call is equal to 160 point, how much that was? 0.50 minus what is the strike price? 150. So can we not say this is also the value of call option? Yes. Can we not say this is also a value of call option? So whether this 14 is right or whether this 10.5 is right, students, I just wanted to draw a parallel here. Why is 14 correct or why is 10.5 incorrect? We have to answer that. See, students, first of all, in this 10.5, this is a wrong assumption to take. Reason being, in the above case, we are making an assumption that there is a loss when expected price is lower than strike price. Yes, Namrata. Yes, perfect. Namrata, your answer is perfect. So, what we are trying to say is that if we take this 160.50, then we are making this assumption that here also the price that has gone below the strike price, here also we are taking the losses, which we should not. Okay. So hence we have to take the individual probabilities, individual cases results, and then only arrive at the overall number, students. Okay. Fine, students. I hope this is clear to everyone. Any questions till now? So just to, take a revision till now so that, in the next part, it is easier for us to kind of take it ahead. So students, first of all, for options, what we discussed is in case of a call option is a right option. It's not an obligation. It's not a mandate to do what? To buy an underlying at a specified price. Okay. And there were two possibilities in terms of the time, whether it is up to an agreed date or at an agreed date. Similarly, for put option, we said that it is a right to sell the underlying. Okay. So these things we have discussed then in terms of the payoffs and other things. Okay. And now we have sufficient evidence to say that if the prices goes up, the value of the call option will also go up. Okay. See, I'll tell you. Today, let's say the strike price, let's assume strike price to be 100. Okay. Today, let's say the spot price is 120. So the broad premium will be 20, correct? As of now, with our current understanding, broad premium will be 20, although it will be adjusted for the time value of money, because this strike price and spot price difference will happen 3 months from now. Let's say time period is 3 months. So this 20 rupees will be adjusted for time value of money. Let's say it becomes 18 rupees, for example. Okay, 2 rupees is basically the present value of this 20 rupees. Okay, as a reduction. Now tomorrow, the strike price, let's say, will remain same, but let's say tomorrow the spot price actually increases to 180. So the difference becomes 80. Now the premium also will suddenly jump up from, let's say, 18 to now 77 kind of a number. Okay, you're getting my point. So there is a direct correlation between the difference of spot price and strike price and the way it changes to the premium, the way premium changes. Okay, students. Now let's do one thing. Let's come to question number 7, I guess. Yes. Let's come to question number 7 first, students. Okay. So the question number 7 says Mr. X established the following strategy on the Delta Corporation's stock. There is a company called Delta Corporation, and that they established the following strategy. They purchased one 3-month call option with a premium of rupees 30. So there is a 3 months call option that they have purchased, and the premium is 30, exercise price is 550. So we should actually put it in a tabular format here. Premium, exercise price, lot size, okay, and total premium. So let's say 3 months call option. The premium was 30 rupees. Exercise price is 550 rupees. Simple. Then purchased one 3-month put option with a premium of rupees 5 and an exercise price of 450, students. So the call option is purchased at an exercise price of 550. The put option is purchased at an exercise price of 450. Delta Corp's stock is currently selling at rupees 500. So the current spot price is rupees 500. Determine the profit or loss if the price of the Delta Corporations remains at 500 after 3 months. What is the period of these? The period of these call options and put options were 3 months. So they are saying, what if after 3 months, the price remains same as 500? And what if the second case is it falls to 350 or it rises to 600? Assume the size of the option is 100 shares of Delta Corp. So first of all, student, we are asked to calculate the profit or loss. Simple. We are asked to calculate the profit or loss. So first of all, student, we first need to calculate what is the premium that we have paid today. So as far as our investments today is concerned, we will have to invest equivalent to the premium today. Okay. So 100 is the lot size, 30 is the premium. So 3000 premium we have paid here. Okay. 100 is the lot size, 5 is the premium. Okay. So we have paid 500 rupees premium here. So in totality, 3500 is the premium that we have ended up paying. Initial payment of premium. Okay, students, initial payment of premium is 3500. Then at maturity, if let's say the price is 500, it remains at 500. Okay. So let's discuss about call option first. Call option, what was the strike price? 550. Now, students, all of you tell me, the strike price is 550. The spot price has become 500. So whether it will be out of the money, in the money, or what, students? Tell me. The call option, strike price is 550. The spot price is 500. Whether this option will be out of the money or in the money or at the money, students. Common answer, students. So the strike, again, I'm repeating, a strike price of the call option is 550. The spot price is 500. The price has moved below the strike price. So it will be out of the money, students. It is not in the money. It will be out of the money, right? Because there will be no benefit. We are talking about call option. Call option becomes in the money if the spot price is higher than the strike price that we have discussed today. Okay. So it is out of the money and hence it will not be exercised. Shruti correct, Mohammed Abdul correct, Tanisha, Namrata, please check once. Mancha, perfect. Okay. Now let's come to another one. Now, students, again, please think carefully and then answer. Okay. Put option, strike price of 450, spot price of 500. Now tell me whether it will be in the money or out of the money. Whether it will be in the money or out of the money, the price appearing in the market is higher than the strike price of the put option. So does this put option will really give some value? When does a put option becomes in the money? If the strike price is, if the spot price is lesser than the strike price. Here the spot price is higher than the, yes, it is out of the money again. Because the put option will be beneficial when and only if the price, spot price, is lesser than 450. So it is not exercised again. Perfect. Now everyone is right. Very nice. Happy to see this. Only Viraj just check once. It is not in the money, it is out of the money. Okay. Rest all of you are perfect. Suraj right, Shruti, Tanisha, Namrata, Shailesh, Mansha. Perfect. Everyone is right. Okay. Now, so the net loss will be rupees 3,500. Yes, Suraj, because this is a put option. Okay. Now let's take second case. Okay. All of you are again required to answer on this. Okay. So just hear this carefully. Now, in the second case, what is the price that has gone to 350? This is interesting. 350 at maturity. Okay. So the share price has moved to 350 on maturity. Tell me, students, call option, which has a strike price of 550, is it out of the money or in the money, students? Come on, tell me. The market price has moved to 350. Is it out of the money or in the money, students? Is it still out of the money? Yes, it is deeply out of the money. Very good. So, Shailesh, Shruti, Tanisha, Mansha, Viraj, Namrata, and Mansha. Yes, all of you are correct. Suraj just checked once. This is again out of the money. This is not in the money because it will not fetch you any value itself. It will fetch the value if the spot price becomes higher than the strike price. It is out of the money. Okay. So it is not exercised. Now, students, careful to answer this. Okay. Put option, exercise price of 450. The strike price is 450. The spot price has moved to 350 below the strike price of put option. Whether now this put option becomes in the money or out of the money, students, come on. Namrata and Mohammed Abdul, you were correct for this out of the money. Perfect. Shailesh, you are right. Namrata, you are right. They have answered for the put option also. Shailesh and Namrata, you are perfectly right. Request everyone else also to answer, please. Very nice. Mancha is saying deeply in. Tanisha in. Shruti in. Very good. Shailesh, Namrata, you've already answered. Very good. So it is in the money, students. Okay. And how much it is in the money? We can calculate 450 minus 350 into what was the lot size? 100. Okay. So 100 into 100, 10,000 will be the gain. Correct? 10,000 will be the gain because this person has purchased these options. Correct? So it will be a gain to him. Yes, Mohammed Abdul, it is in the money. Viraj is also saying, oh no, Viraj, again check Viraj, it's not out of the money, it's in the money. Suraj in, yes, perfect. So 10,000 is the total income. However, there was a premium that was paid of 3,500. So the net gain becomes 6,500. Net gain is equal to 6,500. In the first part, net loss was 3,500, which is the entire premium paid. Okay. Now, students, third part, it becomes 600 at maturity. Come on, now this will be very easy for all of you. Call option. Now tell me for both call option and put option, whether it will be in the money or out of the money. Call option, the exercise price was 550. Put option, the exercise price was how much? Sorry, 450. Yes, very nice. Tanisha and Suraj, perfectly you are right. Now tell me, students, for call option, whether this will be out of the money, and for put option, whether they will be out of the money or in the money. The spot price has moved to 600, students. Yes. Tanisha, you are right. Shruti, you are right. Shailesh, you are right. Namrata, you are right. Perfect. Good to see everyone is absolutely right and following the correct path. 600, yes. So this is absolutely right. So call option will be in the money, students. Mansha is also saying in the money, yes. Mohammed Abdul, yes, you're right. In the money and out of the money. Out of the money, students. Okay. So this becomes how much? The gain here becomes how much? 600 minus 550 into 100, which is 5,000 rupees. And here not exercised, which is nil. Correct? Ultimately, the total inflow will be how much? 5,000 minus premium paid. Premium paid is how much? 3,500. So the net amount of gain will be 1,500. So net gain is equal to 1,500. Okay, students, I hope this is clear. Okay. Now, students, let me actually again come back. We'll look above these questions. Question number three. This was question number one. Yes. Clear till now here, students, right? So then we will move ahead. Yes, perfect. Now let's come to the valuation technique, students. This is actually the most interesting topic of options, okay? Because here you will learn certain things. Here you will learn certain things which are new, okay? Yes, Suraj, 600 is the market rate. That is correct in the previous part, okay? So students, there are three valuation techniques for an option that we have in our syllabus. Okay. However, practically there are lot many valuation techniques that are there. So the first valuation technique that we are going to understand is binomial model. Binomial model. So as the name suggests, bi means two. Bi means by, binomial means two. Whether it can be upper or lower. So this model says that anything has a two-way probability, right? Whether higher will happen or whether lower will happen. So there is no third probability. Then within that upper, there will again be something higher and something lower. So students, let's take an option. Let's take an example of call option to understand here. Uh, Rate of interest is actually 10% per annum. Time, let's assume 3 months. Strike price, let's take as 28. Okay. This is what it is given to us. So we're talking about a call option, which is having a strike price of 28, time period of 3 months, and the rate of return expected is 10%. So for our 3 months will become 10 divided by 12 into 3, which is 2.5%. Okay, students, it becomes 2.5%. Now, what does this model states? This model states, let's say today, which I'm referring to as 0th day, the share price is 30 rupees. Okay. So it says that there is there are only two possibilities. There are only two possibilities whether the price will go up or whether the price will go down. Okay. So the probability of price going up and down is what we have to something calculate. However, it also tells you the range. So the maximum range it can go up to is 10% of the current price. And the minimum range it can go down will again be 10% of the current price. So it is 33 and 27. Okay, perfect. Till now everything is clear. So 30 plus 10%, the maximum range higher it can go up to is 33 and the minimum range it will be 27. Now can we calculate payoffs? And this is I'm talking about after 3 months, right? This is 0 day, and this 33 or 27 is after 3 months. Okay, this is after 3 months. So 33, what will be the payoff? 33 minus 28. This is our payoff, right? Which is 5 rupees. In case, let's say after 3 months, the actual price becomes 33. The option will help you with the 5 rupees of payoff, correct? And in case the after 3 months, the price itself is 27, then the payoff will be 0, correct? Because 27 minus 28, it will become out of the money. Correct, students? Now we need to calculate probability. What is the probability that 33 price will be there and what is the probability that 27 price will be there? And accordingly, can we calculate the price multiplied by the payoff to arrive at the overall value? Yes, we can do. So for calculating a probability, there is a very simple and straightforward formula. So if you ask me, there are two ways to calculate the probability. Okay. So the first way, the probability of prices going up is equal to 1 plus R minus D whole divided by U minus D. We will come to everything. Okay. R is equal to actually rate of interest. D is equal to proportion of reduced price, which is what? 27 divided by 30. Correct? 27 is the reduced price and 30 was the original price. U is actually the proportion of increased price, which is actually 33 by 30. Correct, students? That's all. So if we put the values here, the probability of going up will become 1 plus 2.5 percentage minus 27 by 30 divided by 33 by 30 minus 27 by 30. No, original price is now 28. Strike price is 28, Mansha. Here we assume strike price is 28. Okay. So this gives us a value of 62.50 percentage. Now, since the probability of prices going up 62.50 percentage, probability of prices going down will be 100% minus 62.50 percentage, which is 37.50 percentage. Correct? And since we said that in the beginning that there are only two possibilities, whether the price will go up or the price will go down. There are only two probabilities. So the probability for the price to go down is 37.5 percentage, students. Sometimes apart from this formula, we also can use, sorry, if it is a case of continuous compounding, we can also use a raised to the power r into t minus d, sorry, divided by u minus d. Okay, students. I hope this is clear till now. Shruti is asking, and the possibility that probability will remain same. So probability is always computed today for future, right? Now what happens in future is actually an outcome then and there that no one can guarantee, Shruti. Okay. So all these mathematical models, all these calculations will tell you the best possible outcome. But whatever is going to be an outcome is totally, it can be the same or it can be different also. No one can guarantee that, Shruti. Not even this model and not even other models. Okay, perfect. So till now clear. Now the second way to calculate the probability, students, is called as the risk neutral probability. So under binomial method, so this was the first method. And the second method, we also call it as the risk neutral method sometimes. Risk neutral method. Okay. Now this risk neutral method, it is actually throwing up the probability numbers, right? In a way that the risk will be neutral in both the possibilities. How? Let the probability of price to be 33 BP. So there are only two possibilities, right? 33 or 27. So if the probability of price to be 33 is P, then the probability of price to be 27 becomes 1 minus P, correct? Accordingly, the probability of price to be 27 be sorry, to be 1 minus P, students. Yes, so Tanisha is asking this, right? So Tanisha, this is U. The below one is U. Sorry. In the denominator, this is mentioned as U. Okay. Understood? So this will be 1 minus P. Now, 30 is the today's price, right? So 33 into P becomes the probability multiplied by the price, correct? Of future price, plus 27 becomes the other probability multiplied price, correct, students? But this price is as on 0 day. This price is as on after 3 months. So what we'll have to do? We'll have to actually take a present value of this. Correct, students? So taking the present value becomes 1 plus R percentage. If you divide it by 1 plus R percentage, just a second, students, let me just put it correctly. 1 plus R percentage, correct? So this equation holds good because this is the expected price. If you see the right hand side of equation, this is the expected price, students, correct? And this is the actual price. So probability, we have related the present value of expected price to the actual price. Okay, students? Understood? If we replace these values here, 33 into P plus 27 1 minus P divided by 1 plus 2.5 percentage. So if we solve for this, it becomes 30.75 minus 27 is equal to 6 P. So the P value becomes 3.75 divided by 6, which is equal to 62.5 percentage. So the probability of price to be 33 is 62.5. Probability that the price is 33 is actually 62.50 percentage. And the probability that the price is 27 is actually 37.50 percentage. So the answer remains same, right? Whether the first part or whether the first method or the second method, answer remains same. Okay. So with this, students, for calculating the probability, we have answered, right? And if you see, students, I'll tell you, even this equation is actually derived from the risk neutral method only, students. Okay. So I think let's take a 10 minutes break. Students, we will again reconvene at 8:35 and take our discussions ahead. Thank you. So before going on to the break, we were discussing about the valuation technology from the binomial models end, right? So let me just quickly take in, then we will take our discussion ahead. So what we said is that in case of a binomial model, there are only two possibilities. One is that the price is going to be higher, or the second possibility is the price is going to be lower. In both the possibilities, there are probabilities attached to it. Now, calculating those uh, probabilities, there are two ways. One is using this formula, which is 1 plus R minus D divided by U minus D. And second one is using the risk neutral method, which is again equating the expected price to the current price, the present value of that. Now, students, if you really see what is the value of an option, till now we have studied how to calculate the probabilities, how to calculate the higher price, lower price. Now coming to the real value of the option. Value of option is equal to present value of probability adjusted payoffs. Please remember, students, this is a very, very important line. So the value of an option as per binomial model is the present value of probability adjusted payoffs. So first of all, what is the probability adjusted payoff, students? Can we put here? Yes, 62.50% is the probability. 37.50 is the probability here. So the payoffs multiplied with the probability comes out as how much? 5 into 62.5. 3.125. This is 0, correct? So total becomes 3.125. Okay, students? Hence, the value of call option will be 3.125, which is the probability adjusted payoffs divided by the present, divided by the factor to make it as a present value. So the factor will be 1 plus R percentage, which is 3.125 divided by 1 plus 2.50 percentage. Correct, students? I hope this is clear. So the value of call option is 3.0487. Okay, students? So in a nutshell, the binomial model tells you to draw a possibility tree. Okay. Now within that possibility tree, there are only two possibilities at one point of time. Now after that one possibility, let's say after 33, another two possibilities can be there. After them, there can be another two possibilities. But at a given decision making point, there can only be two possibilities. And with that, we have to construct a, first of all, tree. After constructing that tree, whatever is the end node, for whatever possibilities has come, we have to calculate the probabilities. Now, those probabilities will be used to calculate the payoffs adjusted with the probabilities. Okay. And then the present value will be taken to calculate the overall amounts. Okay, students. We will attempt good amount of questions in this to understand it better. Okay. So till now, students, we have taken only one period, right? One node, possibilities and probabilities. Correct. Now we will take multiple nodes, possibilities and probabilities. So question number, let us go to Question number 8, students. From today's assignment, question number 8. Sumana wanted to buy shares of EIL, which has a range of 411 to 592 a month later. So the higher range is 592, lower range 411. Okay. The present price per share is rupees 421. Spot price, present price 421. Her broker informs her that the price of this share can soar up to rupees 522 within a month or so. So this 421 can go to 522, students. That is what the broker has informed. Okay. Just a second, students. There is some question. 3.125 is the present value adjusted value. Then why did we again calculate PV? No, Mancha. Sorry. In the previous part, sorry. Here what we were studying, just a second. Question number 2, question number. Yes, here. Manisha, 3.125 is the probability adjusted payoff. It's not a present value. See, ultimately what we did here, we multiplied 5 with the probability of 62.5. Payoff was 5. 5 is the 3 months later on value. 62.5 is the probability as on that date. So 3.1.25 is the probability as on that date. Okay. Hence, we have not considered the present value at first place. Okay. Perfect. So let's come back here. So the broker had informed her that the price of this share can soar up to 522 within a month or so that she should buy 1 month call of EIL. So they have informed to take the 1 month call. Now, if the price is going to go up to 522, 1 month call option will be better, right? Because call option will give us benefits if the prices actually moves up. The assurance of which could not be given by her broker. However, there is no assurance that has been given by her. Though she understands the uncertainty of the market, okay, she wants to know the probability of attaining the share price of rupees 592, which is the higher range, so that the buying of 1 month call of EIL at the execution price of 522 is justified. So what they are saying is the strike price of that call will be 522. And hence she is actually seeking our opinion. Strike price will be 522. Hence, she is seeking our opinion that what will be the probability that the prices will be turned out as 592. Advise her, take the risk-free interest rate to be 3.60 percentage, and they have given us the continuous compounding numbers also. Okay. So we are clear. We are talking about today, which is actually there are two options, right? So the downward and the upward calculation we can do, right? 411 is the downward divided by the 421, which is the current price. Okay. This is the ratio of downward. Similarly, the ratio of upward will be 592 divided by the 421. Okay. So the probability that price would be 592 be this. Okay. Okay. Hence, the formula of PU is actually, here we will be using e raised to the power RT. Okay. PP is present price. I have mentioned present price. Okay. Okay, Viraj. Now, PU is actually is equal to, we will be using the continuous compounding formula, the other formula that I mentioned there, right? Divided by U minus D. This is the formula that we have understood. Correct? Now let's use this formula. What is e raised to the power r into t? Now t is given as 1 month. Now the risk-free rate is also given as 3.6. So we will directly take this 0.036 minus D is what? D is the downward prices going ratio 411 divided by 421 whole divided by 592 divided by 421 minus 411 divided by 421. Okay, students, this formula is understood. So how much this becomes? E raised to the power 0.036 is actually 1.037 minus 0.976 divided by 1.406 minus 0.976. So it becomes 0.1418 percentage. So just a second, let me check it. 0.406 minus 0.976. 1.037 minus 0.976. 0.406 minus 0.976. 1.037 minus 0.976. Yes, 0.148, which is actually 14.18 percentage. So the probability that the price will move to 592 after 1 month is 14.18 percentage. Now it's the 3.6% we have assumed to be what is given, because if you see the e raised to the power 0.036 is given already, right? So we have assumed it is for the same period for which the discounting is needed. Okay. Tanisha, yes, you're right. Perfect. Now, students, what we can interpret from this? So if we draw a tree here, okay, if we draw a tree here, just a second. Where are we currently? 421. Two possibilities, 592 and 411. Correct? So this has a probability of 14.18%, and balance probability will be 85.82%. So higher probability is that the prices will move down. Okay. Lower is the probability that the prices will move up, but higher is the probability that prices will move down. Accordingly, they can take a call. Somewhere, I think the strike price will be 522. So with this, that comparison can be done. Okay. Now let's come to the next question. Next question is question number 9, students. Okay. The ones that we have left in between, we will be covering that, students. Okay. Once we have done those concepts, then we will cover those questions as well. Consider a 2-year call option with a strike price of rupees 50 on a stock, the current price of which is also 50. Now, students, see, there is a 2-year call option that we are talking about. Okay. And strike price is actually 50 and the current price is also 50. Assume that there are 2 time periods of 1 year, and in each year the stock price can move up or down by equal percentage of 20%. Either it can move up 20% or it can go down by 20%. And it's total spanning to 0, 1 to 2 years, right? First year and second year both have 2 probabilities. The risk-free rate is 8%. Using the binomial option model, calculate the probability of price moving up or down. Also draw a 2-step binomial tree showing prices and payoffs at each node. That is what is mentioned. So let's start, students. So first of all, they're asking us to calculate the probability. Let's first actually draw a decision tree. Actually, this we call as a binomial tree also. Okay. So A, let's put the node's name also. Okay, so that we are not under a confusion. So let's say 50 rupees is the current price. Now the possibility that it will move up or down by 20%. So the first node, which is B here, the price will become how much? 50 plus 20% of 50 is 60 rupees. Correct, students? Then again from B, okay, first let's complete this. It will come to C. The second option, which is again 50, will become 40 minus 20% of 50. Okay, students. Then this 60 will also have a 20% increase in the second year. Then it can become 72. Correct, students? 60 plus 20% of 60, which is 12 rupees. So 12 plus 60 is equal to 72. Then there is another probability that this 60 can go down from 60 to minus 20% of 60, which is 60 minus 12, which is 48. This is D and then E. Okay. And then again 40 plus 20% of 40, which is 8. It can go to actually 48 itself. So that nodes we can merge actually. let's do one thing. So this is E. Here it was a 40 rupees price. Here it is 48. So 60 minus 20% will be 48. 40 plus 20% of 40 will also be 48, which is 40 plus 8. And lastly, we have F, which is 40 minus 8 will be 32. Okay, students, this is clear. The strike price is how much? 50. So the probability calculation part is easy. These nodes are also easy, correct? So B and C till here, this is year one. Then all these nodes of D, E, and F are at year two. Okay, students, clear? So the probability that the prices will be higher by 20%, correct? Okay, wait. So Tanisha is asking about this joining of the nodes. So Tanisha, what I did is, so 60, so after the price has moved from 50 to 60, that means after we have moved from A to B, there is a possibility that 60 will again go down to 48. Because on 60 itself, there is a plus 20% and minus 20% possibility also. So that becomes 48. Now 50 moving down to 40 also has a possibility of 40 moving up to 48, because 20%, see here what we have done, 40% plus 20% of 40, which is 48. Here what we have done, 40 minus 20% of 40, which is 32. Correct? Similarly, here what we have done, 60 plus 20% of 60, which is 72. Similarly, here we have done 60 minus 20% of 60, which is 48. Okay. So hence 48, 48, rather than keeping two different nodes, we have kept one node because ultimately the value is same. Okay. So the risk-free rate of return for 1 year is how much? 6%. Okay. So it is actually 6%. 1 plus 6% minus. Okay, now we have to calculate what is the ratio of prices going down. Down will be how much? 0.80 divided by 1.00. Similarly, up will be how much? 1.20 divided by 1.00. Clear? Okay. Or if you want to make use of the prices also. Yes, Tanisha, the prices are same, hence we joined them. Mansha, DEF is the second year values. Yes, DEF is the second year values. Or I was referring to, if let's say this seems a bit off, then we can also say D is equal to 40 divided by 50 for year one. Okay. And U is equal to 60 divided by 50. Answer will be same. Okay. So 1 plus 6% minus 40 divided by 50, which is D, divided by U minus D, which is 60 divided by 50 minus 40 divided by 50, students. Okay, so this is the probability of price going up. So the probability of prices going up by 20% is Actually, 1.06 minus 0.80 divided by 1.20 minus 0.80. So this becomes how much? 1.06 minus zero point 0.8 divided by 0.4. 65%. Probability of increase in price is equal to 65%. Probability of decrease in price is equal to 35%, which is 100 minus 65. Okay, so the first part is done. The first part of the question was this much, correct? Using a binomial option, calculate the probability of price moving up and down. This is done. Also drop a two-step binomial. That is also done. And payoffs at each node. Okay, now we have to calculate the payoffs at each node. Calculation of payoffs at each node. Is not node, but node. Now nodes are what? D, E, F, and then B, right? And then C also. And then finally A, correct? So these are the different nodes. D, E, F, then B and C, then A. So always students, we have to work backwards. Then only we will be able to find out the first node value. Reason being, the B's value is actually dependent on D and E. And similarly, A's value is dependent on B and C. So we really need to understand what is the value of these respective nodes. So first of all, let us start with nodes. D node, let us start with. Okay. What is the price of share expected at D node? 72. Expected price, strike price. Okay. Value of call option and remarks. Okay. Okay. Viraj is asking what is node? Node is a point where we are differentiating, or let's say we are stopping, and then again the possibilities divides. Let's say A is a node, B is a node, then B is a place where again the possibility will divide. Now here we have taken nodes at 1 year interval. Reason being, question has asked us to do the same. In the question itself, they have mentioned that you take nodes with a 1 year interval. Okay, students? Okay, Viraj, I hope this is clear. So now the D expected price is 72. Strike price is 50. So 22 becomes the value of call. And can we say it is in the money? Yes, it is in the money. Definitely it is in the money at D node. Then E node, the price is actually 48. However, the exercise price is 50. Value of call option will be 0 because it has become out of the money. Then comes F. F is actually 40. No, sorry, 32. Okay, and the strike price is 50. So it is also out of the money. Okay. Now, students, if you see in the binomial tree, the only calculation of value of call has to happen at the outermost nodes, which is D, E, and F. Okay. Then whatever will happen is just a present value of those outer nodes multiplied with the probability. Now with the B, we will not recalculate. Okay, let me just put it down here and then make you understand. I cannot do at B like this 60, 50, 10 in the money. This is wrong actually. This I cannot do. Reason being, B is again dependent on D and D for its values, right? So we have to accordingly arrive its values. Only D was dependent on this calculation. E was also dependent on this calculation, and similarly F was also dependent on this calculation. So hence we have actually done like this. So for B, 22 is the value of call with the probability of 65% plus 0, which is at E, which is the value of call, right? It has a probability of 35%. But this has to be taken to a present value by 1 year, correct? Because DE were the values after 1 year, which is sorry, after 2 years, and B is the value of before that 1 year, right? So we have to move 1 year. Hence, it becomes 13.49 percentage. Sorry, 13.49 is the absolute value. Sorry, students. 13.49 is the absolute value. Now, similarly, let's come to C node. So students, for C node, E and F has to be multiplied. E, what is the value? 0. F, what is the value? 0. 1.06 if we do, then also it is actually 0 only, right? So B's value is 13.49. C's value is 0. Now, A's value will be how much? Okay, let me do one thing. Let me just draw a tree here with the values now. This was A, B, C, right? Then this was D. This was E and this was F, correct? So the D's value was how much? 22. E's value was 0. This value was 0. B value was how much? 13.49. This I'm talking about the value of call option, right? C value became 0, correct? Now ultimately A's value will be B's value and C's value multiplied by their respective probabilities and the present value of it. Okay. So A will be 13.49 into 65% plus 0 into 35% divided by 1.06, which is actually 8.272. So the value of option becomes 8.272. Sorry. Understood, students? Till now, everything is clear. Please do let me know. So we have understood how to calculate the value of an option using the binomial model. It makes use of probability. It makes use of the different present values, future values, right? But please do remember, students, we have to only calculate the value of option at the outermost nodes, which is D, E, and F. Okay. Then it is just a probability multiplied by the present value. Simple. Okay. Now, can we relate this binomial model to something that we have studied earlier, which is the American and European options? Correct? So American option students, it was told in the previous session that American options have a multiple. So basically they have multiple chances, or I can say up to an agreed date, it can be exercised at any point of time. So that means for every moment, there will be multiple probabilities and possibilities. One, two, then for one again, three, four, like that. So let's say like this. Then again, it can be broken up, right? It can be broken up. So like that, I'm saying there will be multiple trees, correct? Because ultimately for this period, we have to evaluate all the possibilities within that period, right? However, for European option, and this is let's say expiry period. However, for European options, there will be only two possibilities for the entire period. Correct, because European options are relevant only after the expiry of the period is done. Correct, students? I hope this is clear. So this will continue, let's say, till the expiry period. So till this period, the different nodes and different values will continue, students. Yes, now let's come to the next question. Question number 10, students. So question number 10, it says that the current market price of an equity share of Panchent Limited is 420. This is the current market price. Within a period of 3 months, the maximum and minimum price of it is expected to be 500 and 400 respectively. If the risk-free rate of interest is 8% per annum, what should be the value of a 3 months call option under the risk neutral method at the strike rate of 450? Simple. They have actually given us the spot price 420. Time is actually 3 months, within a period of 3 months, right, students? Then the maximum price is actually 500. It's not it's actually the maximum price. Max price is equal to 500. Minimum price is actually 400. If the risk-free rate of interest be 8% per annum, what should be the value of a 3 months call option? If the risk-free rate of interest is 8% per annum, what should be the 3 months call option value? So R is actually 8% per annum. However, for 3 months, the R will become 2%. R for 3 months will be 2%. Correct? And the strike price given to us is 450. Okay, students, all this information keeping in mind, we have to compute the risk neutral method basis the value of call options. Now, one point to note is we will apply the probabilities that have been given under the risk neutral method. And students, let me tell you, the probabilities calculation is similar, right? Whether you use risk neutral method or whether you use binomial method, it's this one and the same thing. Okay. So probability of price going up be X, probability of price going down be 1 minus X. Okay. Now, the probability of price going up is X. So, what is the current spot price? 420. 420 is equal to the maximum price is 500 into X percentage plus 400 is the minimum price into 1 minus, sorry, 1 minus X percentage. Correct? This whole divided by e raised to the power r, which is 8% into 3 by 12. Okay. This is correct. So if we solve this, 420 into e raised to the power 0.02 is equal to 500x plus 400 minus 400x. Correct? So this becomes 420 into e raised to the power 0.02 is given in the question as 1.0202. 100x plus 400. Okay. So this becomes 420 into 1.0202, 428 minus 400 divided by 100. So it becomes 28.48 percentage. If we solve this, x becomes 28.48, sorry, percentage. Okay. This is clear, students. So probability that price would be 500 is actually 28.48 percentage. And probability that price would be 400 is equal to 71.52 percentage. Vansha, we did put E in the denominator because the present value and future value, you will do it like this. Or if let's say understanding this denominator is a concern, we know that Present value multiplied by e raised to the power something is equal to the future value. So this becomes present value and this becomes future value. Okay. So if you see the vice versa of that, if it is in denominator, then also it is fine. Correct? Sorry. Now, the next part is to calculate the value of call option. The probabilities have been calculated. To calculate that, we first need to put a, let's say, a binomial tree. This is, let's say, A, B, C, 500, and next one was 400. The current price was 420. Okay. The probability it will be 500 is 28.48 percentage, and here it is 71.52 percentage. Clear? Now these are the two nodes. Okay. So the price. Okay, let's first take the nodes. Nodes B and C. Okay. Price is how much? 500, 400. Correct? This is actually the expected price. Strike price is actually how much? Strike price is 450, I guess. Yes. 450 in both the cases. The payoffs will be 50 here and nil here. Correct, students? The expected price for a call option. So the expected price for that equity share is 500. The value of that call option will be 50 if the strike price is 450 because the expected price is already higher than the strike price. Then the probability 28.48 percentage, students. This is 71.52 percentage. So probability into payoffs, we can multiply 50 into 28.48 percentage. It becomes 14.24. Then this is nil. So in totality, it becomes 14.24 as the value after 3 months. Now, students, please remember it is the value of an option after 3 months. We have to calculate the value as on today. Suraj is asking, Suraj is asking whether payoff cannot be negative. No, Suraj, payoff cannot be negative. If payoff is a negative, then it is not an option. See, the real essence behind an option is that since payoff is to be determined basis the favorability of the situation. The situation becomes favorable, the payoff will still be positive. If the situation becomes unfavorable, there will not be any payoff. The payoff will be zero, except to the extent of initial payoff of premium that has already happened. So the value of call option, or we can say the node A, correct, is equal to 14.24 divided by e raised to the power r t, which is again 0.24 divided by e raised to the power 0.02, which is equal to divided by the value was 1.0202, which is equal to the value of call option is 13.96. Okay. So this 13.96. Yes, Mancha, PF can be negative in the forward and futures because that is there an obligation. There is no option. So it can be negative there. Mancha, your answer is correct. Shailesh, please check. I think there is some rounding off issue. So 13.96. If somebody asks you, it is a theoretical minimum premium. Okay. Call holder, call writer. Minimum 13.96. Call writer will expect and call holder will maximum pay 13.96. Correct, because call holder will say that I will not be able to pay you more than 13.96 because the maximum benefit I will derive from this as of now today is 13.96. Similarly, for the call writer perspective, the minimum amount that this call writer will expect is 13.96. Okay, students? Okay, now let's come to four cases, students. See, I will put up four cases here and we will be using those four cases in our discussion. Okay. I'm just putting out these four cases so that our thought process works in that direction. Okay. So I'm taking a case one. What if, and I'm talking about the entire hedging technique. Okay. So case one is I'm taking starting from if someone do a long call option. If someone is doing a long call option, that means right to buy is getting purchased, right? If someone is longing a call option, no, Shailesh, we cannot take 1.08 as denominator. 1.08 cannot be taken because first, there is a continuous compounding case. Second, it's only 2%. 8% is for the full year. Okay. Now, students, hear me out. Long call option means there is a right to buy which we are purchasing. And if there is a right to buy, I have to arrange for the strike price equivalent value to if I'm going to purchase an underlying. In our all the previous examples, I have made it clear that in case we are going to purchase the underlying under an option, we have to minimum need the strike price value equivalent amount. So what we will do, we will invest the present value of strike price today. Invest present value of strike price today. Okay. If you do this, then tomorrow you are actually secured from the cash flow perspective because you have taken a long off call option. That means you have taken a right to buy. And if you have invested present value of strike price today, you will be end up getting that proceeds after the expiry. And then you can purchase the underlying in case you want to do at the strike price. Okay. Case two. In case two, we are doing a short of call option. Short call option. In this case, right to buy. You are selling. If you are selling right to buy, you need to make sure that you make available the shares. If that options get exercised. So what you will do today, you will purchase share today. Okay, you will purchase the share today. Case 3, students. Long put option, right to sell. So by longing a put option, I'm purchasing the right to sell. Now tell me, students, what should I do here? If I'm purchasing a right to sell, whether should I purchase a share today or whether I should invest the present value of strike price today, so that once this option becomes exercisable, I don't face any problem. Come on, students, tell me, what should we do? Sorry. So I'm talking about the position to be taken in the cash market and the options market. Let's say you have taken a position of long position in the option market and you have taken a long of put, which is a right to sell. So that means you have purchased a right to sell. Now, once the right to sell gets exercised, what I will have to do? I will have to sell the shares. I will have to sell the shares because I am longing. So that means I have to purchase a share today. Very good, Tanisha. You are right. Mancha, we will not invest today. If I have taken a long call option, then it makes sense to invest today. Okay, but I have taken a long put option, then it makes sense to purchase a share today, because tomorrow, if I am able to exercise the option, I have that purchase share which I can sell it. Then only the right to sell is fulfilled. Then case 4, students. If I have done a short of put option, that means right to sell is actually selling, correct? I am selling the right to sell. That is called a short. Tomorrow, if the exercise of option happens, then I have to purchase the stock. I have to purchase the underlying. If I have to purchase the underlying in future, that means I have to invest the present value of strike price today. Long put means intent is to hold for long period before selling. No, Suraj, no, 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 no. Long put means I'm purchasing a put option. That's all. So, student, these cases are clear, I hope, right? I will be making use of these cases in our further discussion. Okay. But this was just to make it clear that if I do some operations in one market, in second market, which is the cash market, what operations I will be doing, whether I will be purchasing the share or whether I will be investing it. Okay. Now let's come to the next question. Okay. Before that, I think this I have already this I have already spoken. Options premium is always reflective of the extent to which it is in the money adjusted for time value of money. I hope you are getting my point. This statement is clear, right? So options premium will always be equal to the present value of in the money payoff. Simple. Present value of in the money payoff. This is actually value of call or put option both. This is actually the premium, correct? Because ultimately market will not give higher or lower than to what is coming out of this numbers, right? Now let's come to next question, which is question number 11. Okay. So this has come in a earlier ICAI examination. Okay. So just listen to this carefully. We will solve for this. AB Limited's equity shares are presently selling at a price of rupees 500 each. An investor is interested in purchasing AB Limited's shares. Okay, so the current price is 500 and there is an investor who is interested in purchasing these shares. The investor expects that there is a 70% chance that the price will go up to rupees 650 or 30% chance that it will go down to 450 3 months from now. So there is a 70% probability. They have already given you the probability. Okay. There is no need to calculate probability. 650 and there is a 30% probability it will come down to 450 3 months from now. There is a call option on the shares of the firm that can be exercised only at the end of the 3 months. They are talking about European options. Nevertheless, it does not make any difference to us. Till now, we have not studied any valuation difference between both of them, right? At an exercise price of 550. So what is the term? Time 3 months. Call option where strike price is equal to 550. Correct? And this is European option that we are talking about. Calculate the following. If the investor wants a perfect hedge, what combination of the shares and options should be selected? Now, students, I have a very basic question to all of you. This is the cash market, or I can say equity market, where the underlying is getting sold. This is the options market. If I have purchased a share in spot market, what action I should do in options market on a call option? Okay, let's take an example of call option. Let's not go to put option. What action should I do? Whether should I long or whether should I short? I mean, whether should I buy a call option or whether should I sell a call option? Students, come on, tell me. What will you do? If you already have a exposure in a spot market because you have purchased the shares in spot market. So in options market, whether you will buy a call option or whether you will sell a call option to mitigate that risk. Tell me, students. Very nice. I can see a lot of mixed answers, students. Mansha, Shailesh, both of you are correct. Tanisha, I will explain. Okay. So, students, hear me out. Whenever you are in this situation, think very logically and calmly. First of all, you are in equity market, you have purchased the shares. If you have purchased the shares, which type of risk are you facing? Which type of risk are you facing? Yes, Suraj, you're right. Mohammed Abdul, you're right. Perfect. You are facing a risk of downside. Correct? You are facing a risk of downside. If tomorrow the prices goes down, you will lose. Now you have to devise a strategy in options where the prices goes down and you gain. Or I can say if the prices goes up, you don't gain. Whichever way is okay. So that means you will have to short sell the options because then you will earn premium on this, which will compensate your risk of downside. Yes, Tanisha. Okay. So this is clear that here, if we are longing the shares, we have taken a long position in shares, we will take a short position in call option. Okay. I have not yet gone to the put option. Put option we will discuss later. But at least for call option, we will take a short position. Okay. Now the first part, it is asking us to calculate the perfect hedge. What is the meaning of perfect hedge? Perfect hedge means that what is the relationship between equity and option. So uh, for one option, how many shares needs to be traded? Okay, let us put like this. Perfect hedge is actually equal to payoff if price goes up at 650. What will be the payoff? 650 minus 550, students. Yes, all this is based on the speculation, Suraj. 650 minus 550. Where is 550? Is the strike price. Yes. So it will be 100. Correct. Payoff if the price goes up at 650. That means the call option will be in the money by 100 rupees. Payoff if price goes down, it will be 0 because the price that is going down is at 450 minus 550. It is out of the money. It is in the money. Okay. Hence the hedge ratio is actually given by this formula 100 minus 0 divided by 650 minus 450. So the payoff at higher price minus payoff at lower price divided by higher price minus lower price. Okay, Shruti, I will explain. So this is 100 divided by 200, which is 0.50. Okay, so with this, I'm just writing the equation of perfect hedge. Payoff at higher price minus payoff at lower price. This whole divided by higher price minus lower price. Okay. So this has given us the perfect hedge. So it means 0.5 shares to be purchased for one call option to be written. Okay. For one call option to be written, we need to purchase 0.5 shares. Okay. This is the perfect hedge. Simple. Now, Shruti is saying, explain once again. So, Shruti, as I said that if let's say in one market you have purchased the shares, you have taken a long position on shares, you will go and take a you will go and sell the call option to make sure that there is a proper hedging that is happening, because you are exposed to a downside risk and you have to devise a strategy by which you are not losing if the prices goes down. Okay. So this is clear. Then second part of the question, students, explain how the investor will be able to maintain identical position regardless of the share price. So they are saying us to prove that if the share price moves up or down, still the position is same. That we can prove. Okay. First of all, strategy we have devised that zero point 0.5 shares to be purchased for one call option. Okay. Now, A part, if the price on expiry is 650, then first of all, what will happen? Sale proceeds. I am holding a share, right? 0.5 share. So I will take a sale proceeds of 0.50 into 650, correct? Which is 325. Then because I have written a call option, I will have to pay the difference between strike price and the expected price, because in this case, the expected price has moved up. So minus loss on call option. This will be how much? 650 minus 550, which is 100 rupees. So in a nutshell, I will get 225 rupees as the closing cash flow, right? Net cash inflow. I will get this much. Similarly, if the prices moves down, if the price on expiry is 450, then sale proceeds I will still do, but at the rate of 450 now. 50 share on 450 is equal to 225, but I will not incur any loss on call option. This will become nil because already the price is lesser than the exercise price, right? So it will be nil. So hence the net cash inflow in this case also it becomes 225. So hence we have proved, right? The second part was asking us to show that whatever price goes, still you are able to make the same inflow. At price 650 as well as 450, the net cash inflow on expiry remains same. Hence, this is a complete hedge. Okay, this is understood. Then let's come to the next part. If the risk-free rate of return is 5% for the 3 months period, what is the value of the option at the beginning of the period? They're asking us to calculate the value of the option. So simply we can assume the value of the option to be P. Let the value of option B, P. Okay. Now, students, if you see, we have the closing cash inflow, right? If we have the opening cash outflow and we equate them, then we will be able to arrive at the value of the option. Sorry. See, in the opening cash outflow, while we would have taken the position, what was the price appearing in the market? 500 rupees, right? We have purchased how many shares? 0.50. And we have sold a call option. So minus premium of one call option, correct? Because the hedge ratio was 0.5 is to 1, correct? So this is our initial cash outflow. This is our initial cash outflow, students. So this equals to 225, which is the closing cash inflow divided by the present value factor 1 plus R to make it these two values comparable. Okay, students. So this is actually cost paid for 0.5 shares, 500 into 0.5 minus P is the income on writing one call option and equating is to the overall cash inflow that we got. 225 is what we got as per the second step, correct? So this becomes 500 into 0.50 minus P is equal to 225 divided by 1 plus 6% was the rate, or what was the rate? 5%. Okay. If we solve this, then we get 250 minus P is equal to 214.2857, and hence P becomes 35.71. Okay. So the value of call option, which is premium, that we say is equal to 35.71. Lastly, the question is also asking us to calculate the expected return on the option. So students, expected return on the option is what is the payoff, what is the investment, which is the premium, and the difference between those two. So fourth part, expected return. So if we see what is the expected return going to be, which is the expected payoff, that we know 70% is the probability for 100 rupees, correct? In the first part of the question, it was given plus 30% probability for 0 rupees, correct? So it becomes rupees 70. This is the expected payoff. What is the expected return? Expected return will be this 70 rupees minus the premium that has been paid. So it becomes 34.29. Correct? Expected return becomes this much. And in terms of percentage, it becomes 34.29 divided by 35.71, which is actually 96.02% students. Yes, Tanisha, your answer is correct, 35.71. So the expected return is almost 96% on these values. Okay, students. So I hope this question is clear. The only catch in this question was to relate these equation wherein the cash outflows at 0th day is computed to the overall cash inflows present value. Okay. So I hope students, today's session was clear. Today we discussed the valuations technique, except for Black-Scholes model, which we will be discussing tomorrow. So with this, for the today's session, we come to an end. I request C. Ashish sir, who is there with us, to help us with the closing remarks.
Devas, am I audible?
Yes, sir, you're audible, sir.
Thanks a lot. Now, student, I was watching the lecture, and of course, future and options or overall topics are very, you can say, always exciting. That we can, of course, we can make the money. But I want to share one article that I have read I think some days back in Business Line newspaper. According to the same, the recently the retail traders' participation in future and option has increased exponentially. According to one figure, around in October 2023, the figure was 329 trillion rupees. Is comparing to that October 2022, it was 143. So this exponential trading, of course, it is a growth of the market. But SEBI says, or as per the study, it says that out of 11, out of 10, only one basically investor earn the money. Okay, and rest are losing around 1.1 lakh rupees. So you can understand because the trading in a future and option needs emotional discipline. You have to control your emotions. However, as we have discussed in earlier class, here our purpose is not to get speculation. Here our purpose is to get hedging. Okay, as discussed, sir was saying how much option I can write to use the and buy the share for the hedging purpose so that my loss is no profit, no loss is there. So the purpose is our here study is to only the hedging purpose. Of course, speculation question is a small has been covered, but we shall main concentrate our on hedging purpose. Now, student, as such, I have seen that there are not much any query. Devas sir, is there any query that I need to reply specially?
No, sir, not for today's
Okay,
session.
okay, okay, okay. Okay, student, with this, we come to the end of today's session. Sir has told you that he will discuss with you the black goose model. This is one of the very important model, and it is somewhere around. It has, I think, it was in a research paper in the Journal of Finance in somewhere around 1973. So this paper now this concept is used worldwide, and it not only it is limited to financial option, it is also used in real option that we will discuss later on. Okay, Devas sir, thanks
Okay,
for spending your precious time and
thank you.
enlightening on the student on this very complex topic. And students, thanks for patience listening. We shall continue the discussion in next class.
Next.
Okay, have a nice day. Thank you.
Yeah. Thank you, sir. Thank you.
Thank you.